Hello traders, and welcome back to the Forex Geek, where we dive deep into the tools that can help you make smarter trading decisions. So in today's video we're going to be talking about the falling tray candlestick pattern, which is a precise bearish signal that can help you identify key turning points in downtrending markets. So this 5 candle formation reveals crucial market behavior, showing us exactly when sellers are likely to resume control after a brief pause. So you learn exactly how to spot this pattern, you understand what it tells us about market sentiment, and most importantly, how to incorporate it into your trading strategy. So without wasting much of your time, let us get started. So the falling tray candlestick pattern, also known as the falling tray methods, reveals a powerful story about market sentiment through its distinct 5 candle formation. Looking at the pattern structure, you notice it begins with a long bearish candle showing strong selling pressure, and this is followed by 3 smaller bearish candles that stay contained within the range of the first bearish candle. So the pattern completes with another strong bearish candle breaking below the pattern's low. When scanning your charts for this pattern, you need to verify 4 critical elements. The pattern must form during an established downtrend or at the top of a bullish trend, which is for reversals. And the first candle needs to be a substantial bearish candle. Those 3 middle candles should be bullish but remain within the first candle's range. Finally, the last candle must be bearish and close below the pattern's low. So the market psychology behind this pattern is particularly revealing. That initial bearish candle demonstrates strong selling pressure. During the 3 small candles, bulls attempt to push price higher but fail to break above the first candle's high. This shows sellers are simply taking profits or consolidating before continuing downward move. And this is confirmed by the final bearish candle. So you want to avoid some common mistakes when identifying this pattern, and we are going to talk about that later in this video, so ensure you watch until the end. So let's talk about the trading strategy, but before that, let us hop on the charts and try to look for this pattern. So you can see it here clearly. You can see this is the pattern right here, this is the pattern right here, and I'm just gonna hop on the charts and try to find this falling tray candlestick pattern. And this is it right here. You can see this is the falling tray candlestick pattern. We had this bearish candle showing us maximum selling pressure in the market. Then we have the 3 candles in the middle within the range of this first candle, and then the final candle, which is this, is a very long bearish candle showing enough selling volume and selling pressure, confirming the sell signal of the bearish falling tray candlestick pattern. And let me look for another example. So let me quickly look for another example. Okay, this is one. This was in a downtrend already, so I'm just looking for continuations to this downtrend, and price seemed to have changed character from selling activity on a sell trend to a buy trend right here. I'm just gonna change the color to red, and we are looking for price to come back and tap into this support level right here, which is what we would have been expecting for this trade. And price was around here, and we had this first bearish candle. Then we had the 3 candles forming right here, the 3 small bullish candles forming within the range of the first candle, which is a bearish candle, and then the final candle actually gapped below and closed as a bearish candle right here, showing our confirmations for continued selling movements up until our support zone right here. Remember our analysis, the overall trend, and this is on the higher time frame. So after spotting this, you could actually go to the lower time frames for more confirmations or for entries. So let me look for one more example, then we'll talk about the trading strategy. So this is the last example. Let's look at this. You can see this was a top. Actually, we are in a bullish trend, and this was actually used for reversal. In this case, I have the bearish candle, the first bearish candle here, showing a selling pressure entering the market. Then we have the three bullish candles within the range of the first, and we have finally the bearish candle breaking below the first candle's low, and confirming that we are in a bearish trend and we should be looking to sell. So that is exactly how the falling tree candlestick pattern can be identified on your chart. So the optimal entry comes after the fifth candle. After the fifth candle closes, actually, you want to see this final bearish candle break below the low of the first bearish candle, and this confirms the continuation of the downtrend. So place your sell order just below the closing price of the fifth candle, and I'll be looking to place sell entries. Below the low of the fifth candle, which is this, which will be the closing. And your stop loss is straightforward. You should just go above the highest point of the three middle candles, which is right here. You could just place a few pips above, and your take profit should be about 1:2 or 1:3, or you could just target key support levels like this. And this would have given us this trade using the falling tree candlestick pattern. Now remember, you shouldn't trade this without context. You could use your moving average or your support and resistance, or your RSI or your MACD to confirm your trades and ensure that you are trading in line with the overall market. For example, we could just add our moving average to this. I'd like to see price go below the moving average, let's use the 20-day moving average. I'd like to use the 20-day moving average in this case. And if you see price go below the 20-day moving average, it's a confirmation that we should be looking for sales. And you can see price going below the 20-day moving average right here, showing us that we should be looking to enter sell trades at this point. This is a confirmation that yes, the candlestick pattern we saw here, we could use this additional confirmation to confirm the sell trade, instead of just entering at the low or at the close of the fifth candle. So this is for just added confluence or added confirmations. So volume also plays a crucial role in confirming your trades. You could look for increased volume on that final bearish candle, and this shows strong seller conviction and increases the probability of a successful trade. So lower volume during the three middle candles is actually preferable. And just add that volume indicator so that we can see. And this is the volume candle. This is the volume indicator, and you can see, validating our pattern with volume, you can see this reducing buying volume around here, corresponding with these three candles in the middle. And you can see the increased selling volume with this, and also the increased selling volume with this also. I'm going to look at other examples shortly, but just to show you how volume plays a crucial role in confirming your trades when using the falling tree candlestick pattern or the falling tree methods. So before entering any trade, ensure the broader market context supports your setup. Check higher time frames for alignment with the downtrend, and look for nearby support and resistance levels that might impact your trade. Consider whether any major news events also could affect your position. Let's just go to our first or second example to show volume analysis. So remember, this trade We'd like to see reduced volume within these three middle candles, the three candles in the middle, and you can see corresponding with this we have reduced volume right here. See those three volume bars, those three little volume bars shows that buying volume or the buying pressure around this area is relatively small compared to the two selling volume beside it, which is in the air, which just corresponds with this bearish candle and this bearish candle. So volume plays a crucial role in this case, and it's essential you use the volume to confirm your trades. Also, position sizing is critical for managing risk. Never risk more than 1 to 2% of your trading account on a single trade, regardless of how convincing the pattern appears. So calculate your position size based on the distance between your entry and stop loss. Alright traders, we've come to the end of today's video. Engage with us in the comments below. We want to hear about your experiences using this candlestick pattern. So if you found this video helpful, don't forget to like, subscribe and turn on the notification bell so you never miss out on more trading tips and strategies. Thanks for watching, and I'll see you in the next video.